Hey everyone, and welcome back for another deep dive with us. You ready to tackle a topic that I think a lot of people find a little intimidating?
I'm ready. What are we diving into today?
We're going to be talking about Indian mutual funds, and specifically the different categories based on market capitalization, like large cap, mid cap, and small cap.
Okay, yeah, those terms get thrown around a lot, but I think it's really helpful to break them down, especially since a lot of people are looking at the Indian market these days, trying to figure out where to put their money.
Exactly. And to do that, I think we need to start with a basic question, and I know it might seem overly simple, but it's important. What exactly is market capitalization?
So imagine the whole stock market as a big pie, right? Slice of that pie is a company. And the size of that slice, well, that's basically its market capitalization or market cap. It's the total value of all of a company's outstanding shares.
So a bigger slice of pie means a bigger company in the market, essentially.
Exactly. And to figure out which slice is which, the Securities and Exchange Board of India, or SEBI, does the work of ranking companies based on this.
So SEBI is like the official pie
Yeah,
slicer.
you could say that. They rank companies from 1 to 250, and then beyond that based on their market cap.
Got it. So that ranking helps us understand, at a glance, which companies are the big players, which ones are kind of in the middle, and which ones are maybe newer to the game.
Right. And of course, these rankings can change over time, as share prices go up or down, but it gives us a framework.
Okay, so let's talk about those rankings. And let's start with, I guess, the top tier, those big established companies. What are they called again? Large cap?
Yeah, large cap. These are those top 100 companies in India, the ones that have been around for a while. They have solid track records. Think of, companies like Reliance or SBI, ITC, those kinds of big names.
So these are the companies that if I was going to invest my money, I wouldn't be losing too much sleep at night. A little more stable, a little more
Well,
predictable.
nothing in the market is completely predictable. But generally, large cap companies are considered to be less risky. They've weathered storms, they have those solid histories, and they're less prone to big swings in value compared to, smaller companies.
Okay. So if I'm looking for steady returns, not necessarily spectacular growth, but something stable, large caps might be a good place to start.
Exactly. Especially if you're more risk averse, if you really want to protect your capital, large cap funds can be a good starting point.
Okay, that makes sense. But what if I'm willing to take on a little more risk,
Mm.
hoping for maybe higher returns in the long run? What about those companies that aren't quite giants, but they're definitely not tiny startups either?
So then you're talking about mid cap companies.
Right, mid-cap. Remind me where they fall in the ranking.
Mid-cap companies are those ranked from 101 to 250 by SEBI. And, they're often called the sweet spot for balanced growth because they're not as massive as those large cap companies. But they're also not tiny startups. They've got some track record. They're established. Think of a company like Godrej Industries or Voltas, for example.
So they're kind of in that middle ground where they have the potential to grow, maybe even outperform the large caps over time.
Yeah, that's the idea. But of course, with that higher potential for growth comes a little more risk. They can be a bit more volatile than large caps. Their stock prices might fluctuate more.
So it's kind of that classic risk-reward trade-off.
Mhm.
Higher potential reward, but you also have to be prepared for a little more of a bumpy
Right.
ride.
And I think it's important to be honest with yourself about how much risk you're actually comfortable with.
Yeah, absolutely. Okay, so we've got large cap, the giants, the more stable ones. We got mid cap, those with room to grow, maybe a bit more volatile. What about the newcomers, the companies that are really just starting to make their mark?
Those are the small cap companies. And
But
yeah, they can be exciting.
small cap, where do they land in the ranking?
Small caps are ranked 251st and beyond. They might be newer businesses, disruptors in their industries. They're definitely more agile. They can adapt to change quickly, and they've got that potential for, really significant growth.
I like that you used the word agile.
Yeah.
Because if we think back to that pie analogy, if large caps are those big slices, the ones that take a while to move, small caps are like, what? Little speedboats zipping around it?
Exactly. They can turn on a dime. But of course, they also might run into some choppy waters.
Right, because if they're newer, less established, there's a lot more risk involved.
Definitely. Small caps are considered the highest risk category in this world. They're much more vulnerable to market fluctuations. And honestly, not all of them are going to succeed. Some might even go under. So that's why small cap funds are generally recommended for people who can handle a lot of risk, people who can handle the volatility, who are in it for the long haul.
So not for the faint of heart, I guess.
Right. But the potential rewards can be big.
So, okay, we've got our large caps, the ones, well, like those big steady ships or mid caps, the ones with room to grow, maybe a bit more agile. And then we've got those small cap speedboats zipping around.
Yeah.
But how do we decide which one is right for us?
Yeah, it's not as simple as just picking a size, right? It really comes down to your own personal situation, your risk tolerance, your financial goals, and how long you plan on investing. It's like, choosing a travel destination. Some people are looking for a relaxing beach vacation, and some people want to climb a mountain.
I like that analogy.
Mm.
So it's about figuring out what kind of investor you are and then matching that with the right type of fund. But what are some of the other things we should be looking at when we're trying to evaluate these funds? Because I know it's not just about market cap. Remember, our research mentioned something called an expense
Yeah,
ratio.
the expense ratio. That's basically the annual fee that a mutual fund charges to cover all its operating costs. So things like administrative expenses, paying the fund manager, marketing, stuff like that.
Okay, so it's like a management fee.
Right. And it's usually expressed as a percentage of your investment.
So let's say I'm looking at two funds that seem pretty similar in terms of their investment strategy, their past performance, all of that. But one has an expense ratio of 1% and the other has an expense ratio of 2%. Does that really make a big difference?
It might not seem like much in the short term, but those percentages can really add up over time, especially if you're investing for the long haul. If you're thinking 10, 20, 30 years down the line, even a small difference in expense ratios can significantly eat into your profits.
So generally speaking, a lower expense ratio is better.
Yeah, I mean, all else being equal, you want to look for a fund with a lower expense ratio because it means more of your money is actually going towards investments and not towards fees.
Okay, so expense ratio, definitely something to keep in mind. What about the people who are actually managing these funds,
Yes.
making those investment decisions? How much weight should we give to the experience of the fund manager?
Yeah, the fund manager, they're super important because they're basically the captain of the ship. They're the ones doing all the research, analyzing market trends, choosing the stocks. So you want a fund manager who's got a good track record, someone who's consistently outperformed the market, someone who knows what they're doing.
So it's kind of like going back to that travel analogy. You want a really experienced guide if you're going on a mountain trek.
Exactly. You want somebody who knows the terrain, who can anticipate challenges, who can help you reach your destination safely. A good fund manager can make a huge difference in the performance of a fund. And this is where a lot of people, they look at something called past performance history when they're evaluating funds.
Right, I've heard that phrase
Yeah.
before. But I'm also always wary of that because I know that past performance doesn't always guarantee future results, right?
Yeah, you have to be careful about reading too much into past performance. It can give you some insights into how a fund has performed historically, but it's not a crystal ball because market conditions change all the time. And what worked well 5 years ago, it might not work well today.
So it's more about understanding the overall strategy of the fund, the expertise of the fund manager, and how those things align with my own personal investment goals and risk tolerance.
Yeah. And honestly, I think one of the most important concepts for any investor to understand, regardless of what kind of funds they're looking at, is diversification.
Diversification, I've heard that term a lot. What does it mean in the context of mutual funds?
So basically, it means not putting all your eggs in one basket.
Right.
Instead of investing in just one fund, one sector, or even one market cap, you spread your investments around. You diversify. So that way, if one part of the market takes a hit, your whole portfolio isn't going down with it.
So even if I was really excited about small caps, it would probably be wiser to have some exposure to large caps and mid caps as well.
That's right. Because diversification can really help reduce your overall risk. It's about creating a portfolio that can withstand different market conditions. Whether the market is going up or down or doing something in between.
So we've talked about the different types of mutual funds based on market cap. We've talked about expense ratios, fund managers, and we've talked about diversification. It's a lot to consider, but I'm actually starting to feel like I have a better grasp on all this now. But it still seems like a lot of work to figure all this out. Are there any tools or resources that can kind of help make this process a bit easier, a bit less intimidating?
Definitely. And actually, one that's really helpful that our sources talked about is the mutual fund calculator.
Oh, yeah, I've heard of
Yeah.
those. But full disclosure, anything with the word calculator in it kind of makes me nervous.
I get it. I get it. But honestly, mutual fund calculators are way more user-friendly than they sound. It's basically a way to personalize those investment projections. You just plug in some basic information, like how much money you want to invest, your time horizon, how long you plan to invest, and your expected rate of return.
Okay. And then what? What does the calculator actually do with that information?
Well, it crunches the numbers and it gives you an estimate of how much your investment might grow over time. You can
Ooh.
kind of see how different scenarios might play out based on the choices you make.
So it's kind of like a sneak peek into the future of my investment.
Yeah, exactly. It lets you play around with the different investment amounts, different time frames, and even different risk levels. So you can see, like, okay, if I invest this much in a large cap fund versus a mid cap fund over 10 years, what's the potential difference in growth? Or what happens if I bump up my monthly investment amount?
Okay, yeah, that actually does sound pretty helpful. It kind of takes some of the guesswork out of it. And you know what? Now that you mention it, I also remember our sources talked about something called SIP, systematic investment plans.
Oh, SIPs. Yeah, those are super popular in India.
They are. I've heard the term before, but I'm honestly a little fuzzy on what they actually are.
So basically, an SIP is a disciplined way of investing in mutual funds. Instead of putting in a big lump sum all at once, you invest a fixed amount regularly. It could be every month, it could be every quarter.
So it's kind of like setting up an automatic savings plan, but for mutual funds.
Exactly. It's a great way to make investing more accessible, even if you don't have a ton of money to invest up front.
Okay. So it makes it easier to get started and be consistent. But are there other advantages to using SIPs?
Yeah, a big one is something called rupee cost averaging.
Rupee cost averaging. Okay, that sounds complicated.
It's not as complicated as it sounds. Basically, because you're investing regularly with an SIP, you're buying units of the mutual fund at different prices. So when the market is down, your fixed investment amount buys you more units. And when the market is up, you buy fewer units. Over time, this can actually lower your average cost per unit, which can potentially lead to better returns.
So in a way, you're taking advantage of the natural ups and downs of the market. It's like
Mhm.
buying stocks on sale when the price is low and then buying fewer when the price is high.
Exactly. It's a really smart way to manage that market volatility without getting too emotional about those short-term fluctuations.
It sounds like it could help take some of the stress out of investing too.
Definitely.
Yeah,
Because you're not constantly trying to time the market, trying to guess when to buy or sell. You're just sticking to a consistent plan.
that makes a lot of sense. Well, I have to say, this deep dive has been incredibly eye-opening. I feel like we've gone from feeling a little intimidated by the whole world of mutual funds to actually having a decent understanding of the basics, the different types, how to evaluate them, and even some of the tools and strategies we can use.
Yeah, and the key takeaway here is that there's no one-size-fits-all approach to investing in mutual funds. It's about figuring out what works best for you, your goals, your risk tolerance, and your time frame.
And also doing your research, understanding those expense ratios, the fund manager's track
Right.
record, and not being afraid to use those helpful tools like those calculators you were talking about.
Absolutely, because knowledge is power,
Yeah.
right? And when it comes to investing, the more informed you are, the better decisions you can make.
Couldn't agree more. Well, on that note, a huge thank you to everyone for joining us on this deep dive into the world of Indian mutual funds. And remember, investing is a journey. There's always more to learn, new strategies to explore, and we'll be here to guide you every step of the way.
So keep learning, keep exploring, keep those questions coming.
And until next time, happy investing, everyone.